Hi, I'm Nicholas Petruska, and I'm the CFO of Hennessy Capital Acquisition Corp 6, which is a well-known SPAC sponsor. I've been the CFO of each of the previous 5 Hennessy Capital sponsored SPACs. Before that, I was in kind of regular way middle market buyouts and investment banking before then. Just to put it in perspective, we put our first SPAC on file in what we like to call the dark ages of SPACs in 2013. So we've been in the asset class for about approaching 10 years at this point. The year we IPO'd our first SPAC, I think the number of SPAC IPOs could be measured in the single digits. I believe moving forward, as we're approaching the IPO for our third SPAC, I remember every single roadshow investor meeting saying, guys, do you know there's about 30 to 40 SPAC sponsors out there? Do you think the market's going to be able to take 30 to 40 SPAC sponsors? That's a pretty incredible amount. Kind of fast forward the tape, I think we reached peak SPAC. Alysa, or people here can correct me when I'm wrong, I think around 900. So that really goes to show how much the asset class changed in just literally the last decade. But despite having that purview of the last 10 years, I can honestly say that the last 12 to 18 months have been by far the biggest period of change we've seen in the SPAC asset class. And we're going to dive into many of those key topics such as the boom and the bust, proposed new SEC regulations, issues around the excise tax, redemption outcomes, and things of that like. But since it is a corporate governance conference, I think we're going to kick off with, one of the very few questions that we have in the SPAC side around corporate governance. But maybe before going into that, allow each of my panelists to introduce themselves.
Sure. Thank you, Nick. We've known each other for a long time. Alysa Craig, Managing Director at Stifel. I run our SPAC practice, have been in investment banking for over 23 years and around SPAC product for almost 16 years. So not new to the product. We've built a pretty big practice at Stifel and very active in the market in all parts from the initial IPO to these SPACs, capital raises around SPACs, sell sides, buy sides, and have known everybody on this panel for quite a bit in that context.
I'm Layne. I'm a capital markets and mergers and acquisitions partner at Vinson and Elkins, and I don't have quite as long of a record with SPACs as some of my panelists, but I've been primarily doing SPACs for the last about 3 years, representing either the SPAC or the target, pipe investors, underwriters, really pretty much all of the participants in SPAC transactions.
Hi, John Marchisi, National Director of Gallagher's SPAC segment. We are the 3rd largest insurance broker in the world. We're broken up into niche-focused practice groups, either by coverage vertical or industry vertical. So the SPAC segment is domiciled within the financial institutions practice. Prior to that, I actually gained my SPAC experience on the floors of the American and the New York Stock Exchanges, where I served as an exchange official and a managing director for just over 15 years.
Great, thank you. As I said, given we're talking about corporate governance here, one pretty interesting and relatively new issue SPACs are facing is effectively say that the corporate governance structure of SPACs is fundamentally being challenged right now. And what I mean by that is if you really look at the nature of a SPAC, it's kind of akin to a private equity style investment vehicle via the public markets. And typically from that, the SPAC board is generally going to be populated with people who are close to the SPAC sponsor, and generally the SPAC board is compensated through owning founder shares or owning a piece of the sponsor promote. That structure has been tried and true, but recently there's been some challenges in the Delaware courts that's really kind of challenged whether that presents a potential conflict. And there's some recent ones, and I'll maybe hand it over to Ramey to walk through this, but the multi-plan judgment and more recently the Gig 3 judgment, kind of what those were, how the courts are saying some of these things should be viewed through the lens of entire fairness as opposed to business judgment, and what that means to SPAC sponsors today and how corporate governance and maybe even how you select and compensate your directors going forward may be changed.
Sure. So the 2 cases really are pretty impactful to how deals can be structured and how directors are compensated. in Multiplan, there were allegations that the SPAC knew that a major customer of the target, which was Multiplan, was going to terminate its relationship with Multiplan and stand up a competitor. So it'd be pretty bad, and they didn't disclose it in the proxy, and alleged basically a breach of fiduciary duty by the directors because all of the directors had founder stock in the SPAC, which would expire worthless if the SPAC didn't do a deal. So you hear this allegation, a bad deal is better than no deal for the sponsor. And because they have conflicting interests with the public, then that they're supposed to basically prove that the deal was entirely fair to the public rather than getting the presumption that if they do their diligence, any action that they propose is in the best interest of the company. That case had pretty bad facts. I mean, the fact that the competitor was going to terminate, or the customer was going to terminate the deal and stand up a competitor was pretty clearly material if they knew it. And the directors in that case had founder stock that was worth millions of dollars, which is different from most SPACs. Most SPACs compensate the independent directors with something like $20,000 to $40,000 worth of stock, or probably off on that. It's $200,000 to $400,000 worth of stock, not millions. So that case had bad facts and effectively opened the door to make similar allegations about all SPACs. I was speculating that you could say if I had less stock as an independent director, it wasn't material to my investment to my decisions, and I would still be independent. But the more recent case, the gig case, basically survived a motion to dismiss on an allegations that just not telling people how to do the math about how much each share of stock in the SPAC was going to be worth based on how much underlying cash there was, just failing to do that math and suggesting that because the SPAC and the target agreed to sort of value the equity compensation paid to the target at $10, which is pretty well universal, somehow misled the public that their stock would be worth $10, and that one had substantially smaller interests of the directors and also survived a motion to dismiss. So very, very big. We have seen some SPACs starting to compensate one or more of their independent directors with cash, which is kind of rough. At least some of these SPACs were having a hard time raising enough cash to just basically IPO the SPAC, so it requires more cash from somewhere. And then others, probably the easiest thing to do is all future SPACs should be IPO'd out of the Cayman Islands because they don't have entire fairness. It's a Delaware law concept exclusively. So that is probably what you're going to see is all future SPACs go to the Caymans.
That's very interesting. And we'll get to the excise tax issue later, but I think that would also drive a lot of SPACs to be in the Caymans. John, from what you're seeing from your vantage point and purview, how have you seen these recent judgments impact the market, if at all?
The insurers have been on guard for this for quite some time, and what it ultimately boils down to is an increased cost of defense, right? So you're talking about, the market has shifted. There's so many different ways to answer that question, but the market, I would say that insurance, if it's programmed correctly, which is a massive challenge. I know of 150 SPACs out there with deficient programs. If the insurance is programmed correctly, it is responding. We are seeing settlements paid, in the tens of millions of dollars. It's really a focus on going forward and educating the teams and the stakeholders about the potential scenarios that they're going to be facing. We're talking about a shifting environment with smaller deals, with less recirculation of cash at the close, which is translating ultimately into smaller balance sheets with which to indemnify. So that's really the key. The insurance marketplace has softened for several different reasons. The only way that the insurance marketplace softens in this, and I say it multiple times, it's proper to, in contrast to popular opinion, insurers are not averse to risk. They're averse to surprise. And that's the biggest issue with this market is that, there's not enough claims data out there for them to really, truly inform their decisions. So they're looking to quantify it better with these claims maturing, with seeing settlements, with seeing with fairness versus the business judgment rule, all of these things. Secondly, our marketplace has lost a huge pipeline of high dollar premium prospects. So you are getting competition in the marketplace, but honestly, I feel like it's short-lived because it's more opportunistic in the need to deploy capital versus an actual shift in appetite.
Great. Thanks, John. So kind of where I started, we IPO'd our first SPAC. As I said, you could count on one hand the number that went public that year, and we peaked at around 900. I think a big chunk of that 900 all IPO'd in a pretty short period of time. So what we're seeing now is a significant maturity cliff, which really began in earnest in December of last year and continuing through Q1. I could have Alysa walk through the numbers, but I think upwards of $50+ billion have been returned to investors through SPAC maturities and liquidations in the last handful of months. So Alysa, curious from your seat, how you see the SPAC maturity cliff impacting the broader SPAC ecosystem for investors, sponsor teams, and targets.
Sure. I don't think it's a secret. Everybody's been watching SPAC market unravel from its heights. What happened in the market in the last couple of years was completely unprecedented. To put things in perspective, last year was supposed to be a down year. There were still 86 SPAC IPOs priced. To compare to a regular IPO market, there were as many regular way IPOs in excess of 10 million. And if you look at the regular way IPOs over 50 million of proceeds, there were only 23 last year, and there were 86 SPAC IPOs done. So it was still pretty high number, and then the year before that it was 613. So obviously, SPAC is an alternative way to go public. It's not for every situation. And there is a limited number of deals or targets at any given time that qualify for this solution. So it's not surprising. There were some accelerants that occurred on the regulatory front, with some of the recent Delaware court decisions that probably accelerated the liquidations, and also excise tax was a unintended consequences that further created some challenges that caused this wave of liquidations. But at the end of the day, it's a natural process of market processing and digestion, because there is just simply, at some point we had over 500 SPACs looking for targets in the market. There aren't just enough targets of quality that could deal with these vehicles. So it's a natural process of adjustment. A number of factors accelerated liquidations in December in particular. In December, in a single month, $28 billion were returned to the market through the liquidations. And if you aggregate October through to date, it was close to $40 billion. So the big question, of course, now is what will happen with these $40 billion and where that capital will go.
Thanks, Alysa. I mean, you've been around the market even longer than I have. What do you think it's going to level off in terms of annual issuance?
Well, I wish anybody had a crystal ball, so we obviously can't really determine where sort of the natural, if you go back to 2019 and prior, and this, SPAC product has been around since the 90s, so it's not new, it kind of transformed over time. But if you go into the 2019, 2018, which is sort of a current iteration of the structure, you had probably about 100 SPACs looking for a target at any given time, and that was really sort of a healthy pace and was matching the number of companies in the market that potentially could have been good targets, and a SPAC was the right solution for those companies. Whether or not we go to that number and we're in that sort of plateau, where's that normalized level, we have yet to see. But if you step back and you think about that $40 billion of capital that went back to the market, what are the options? So, of course, some investors will exit the product. They will redeploy capital to, with the new opportunity cost of capital, there are other ways to make yield. It's not a secret that majority of investors in a SPAC vehicle are yield-oriented investors. They will find yield elsewhere, but let's assume some portion of it wants to continue to be around SPAC product and look at it. So what are their options? Option number one that has been very popular in the sort of the last sort of 6 to probably 10 months was to look for secondary trade, meaning look at the SPACs that are in the market looking for targets, haven't done a deal, and try to pick them up on the cheap. There is a redemption price, let's assume it's $10 and a little bit higher. A number of issues were trading below that $10 mark that created an interesting opportunity for an investor to buy into an existing SPAC with a good management team instead of putting their money into an IPO. Well, that picture has reversed completely. If you look at where things are trading right now, only 2% of SPACs looking for targets right now trading below $10 a share. The rest of them are trading at sort of $10.30, $10.35, so that opportunity is gone. So that's not an efficient way to deploy capital anymore. What is another opportunity? There's tons of expiring SPACs, the ones that already expired that are looking, the ones that are, the maturity cliff. There are still 350 SPACs remaining in the market, and 70% of them are looking for targets. They have different amounts of staying in trust post-extensions, and the majority of them have extension deadlines in the next 6 months. So if I'm an investor and I want to sort of play a different angle, there is an opportunity, and we're seeing that in the market, to go and buy a sponsor. Basically go and buy an existing expiring SPAC, somebody who is running out of capital, can't afford to pay for an extension, or somebody who doesn't want to pay for an extension. What does that represent? A couple of observations. One is it's a completely different risk profile because you're buying into at-risk investment. You're buying into a SPAC sponsor. It's not, your investment is not going to be underpinned by a redemption right, high risk, high return. The second is you basically will have to control the deal flow, so you'll have to be actively involved in seeking a target. You better have something lined up that you can put into the SPAC. And the third one, the real risk, and what we are seeing in the extensions, in the last 60 extensions in SPAC deals, there were on average only about 20 to 30 million of capital stayed in post-extension, regardless of the size of the SPAC. There were a few outliers of people who managed to keep 100 million plus, but majority of deals, 2/3 of the deals, have less than 50 million staying in trust. In the meantime, you're keeping all of the dilution from the initial SPAC. Founder shares, warrants. Warrants are really, public warrants are really hard to deal with until there is a deal and you can actually try to launch a exchange by restructuring by consent. So is this really an interesting opportunity? Maybe, but you're facing sort of that extension risk where you may end up with a company that has very little registered shares left, barely enough to meet the NASDAQ requirements, and then you still have to find a target and they have to restructure all the dilution that comes from the original SPAC. So that leaves the third option, which is to put money back into a SPAC IPO. And there have been actually a number, so there were 2 IPOs done this year. Last year, as I mentioned, there were actually 86 SPAC IPOs done. They are reflecting, the terms are reflecting the new sort of yield reality. You can dictate the terms, and the hope is, there was an earlier panel today that discussed the opportunity for the new sponsors coming to market. There will be a big there's a big backlog of public companies that wanted to go public because public IPO market was challenged. That backlog is out there. And not all of these companies, as markets begin to open up in the context of a regular way IPO, will be able to go public a regular way. So that represents an interesting opportunity for anybody who is willing to back an established management team, and that's probably where the future is people like Hennessy who have prior track record and people who can write a check into the deal.
Thanks, Alysa. Yeah, I totally agree. Like anything in capital markets, timing is everything. So I think there's going to be significant opportunity in front of sponsors who raise new vehicles, call it in the coming next 1 to 3 quarters. Maybe changing topics a little bit, I think one of the items which have gotten a lot of headlines recently are the new proposed SEC rules. So maybe hand it over to Ramey and John, maybe kind of walk through what were the proposed rules, kind of where are we in that process, and when do we expect to be finalized? And I think most importantly, how do you think that will operate? How do you think that will impact how people operate between SPAC sponsors, targets, as well as investment banks supporting transactions?
Sure. So, yeah, I mean, the proposed rules aren't that new anymore. I think it's been 11 months since the SEC proposed them and then had to reopen the comment period on them. They got a lot of press. The SEC is proposing to do a whole lot of things in their proposed rules. Some of it just effectively codifies what market practice was already doing, though. I mean, the SEC had been saying you should be putting this in your IPO disclosure, you should be putting this in your de-SPAC disclosure, and so for a year plus, we sort of already been complying with a lot of what they're doing. There are a handful of really impactful ones, though. One that people have talked about a lot is eliminating the Private Security Litigation Reform Act safe harbor, people call it the PSLRA, for forward-looking statements. The theory of the SEC is a de-SPAC is really just an IPO by another name, and in an IPO, the PSLRA doesn't apply, so you don't have that safe harbor. That gets a lot of chatter, but I personally don't think that one's that important. It's the biggest thing that they're proposing is to add a rule that expressly says that any bank who IPO'd the SPAC and participates or gets paid a fee in the de-SPAC is a statutory underwriter and has liability for any material misstatement or omission in the de-SPAC disclosure. And they also, in the proposing release, while they're not proposing a rule to this, they said, oh, and by the way, the definition of underwriter that we have already from 1933, that definition says that anyone who participates in an offering is an underwriter. So basically, they just sort of did a scatter shot. You know, we think everyone who participates as a pipe placement agent, who knows what other, maybe it's M&A advisor, is a quote-unquote underwriter under the existing rules. So a really sort of aggressive interpretation by the SEC and one that caught a whole bunch of participants off guard. There were hints that the SEC was going to do something like this in some of the speeches that they had done. So that one's big, and that one's sort of, that damage has already been done. Even if the SEC doesn't adopt its rules, unless it recants that statement, which I don't think they're going to do, you're going to have this concern by the banks that they might be underwriters now, and they might have underwriter liability on disclosure, including on projections. So that's the more important part of, not the PSLRA. They're doing a couple other things that are sort of more technical in nature. They're adding a safe harbor around when a SPAC would be treated as an investment company, because while it's hunting for targets, it's exclusively invested in short-term U.S. government securities. That one's, like I said, more technical, but depending on what rules they adopt, like what does it mean for SPACs that have already gone public and have been around and didn't comply with those rules because they didn't exist? So, you know, how do they comply if they weren't in the safe harbor? And then they've added a few other things like requiring the board to disclose whether they think the transaction is fair to the public shareholders. And a lot of people think that might drive a whole bunch of SPACs to require fairness opinions in connection with these SPAC transactions. Where we are in the process is the SEC got about 86, I think 85, 86 comments from us, from industry professionals, from you name it. Professors submitted a lot of comments. The SEC is supposed to take those comments, process them, and actually respond to them when it adopts final rules. They've said they will adopt the final rules in April, but we'll see on that. It's a tentative target. But they could, adopt them as proposed. They could modify them and adopt them. They could, frankly, they could just decide not to adopt them at all and just leave them sitting out there. They've done that before, where it took them a decade between the first proposal to adopt rules. Or they could do, any number of those. They could adopt in part, reissue in part. It's sort of, who knows?
And on projections, I mean, you raised that point. I think that's one that gets a lot of press. How have you seen targets and sponsor teams think about the use of projections? I mean, look, speaking for myself as someone who was to sign off on all of our public filings, I feel a lot more comfortable not feeling the market precedent of having to put something out there beyond 12 months because, 12 months ahead is already hard enough. But so I actually like that it kind of creates a level playing field for all sponsors out there, since we kind of compete in the end of the day. But how have you seen the market reacting to the use of projections and how they think about that?
Sure. So the market has reacted by largely eliminating projections from the disclosure. You still see them from time to time. Sometimes you have to disclose them because they're the basis of a fairness opinion, so you'd have to put them in there. But I think by and large part, people have either reduced the number of periods they're projecting to be just 1 or 2 years, or they're not doing a full sort of like, revenue, EBITDA, gross margin, whatever projections. They're just like projecting unit economics of, if we build one of these things, here's what the cost will be, and here's the TAM is 1,000 units, so you can do the math. It's been a hot topic. It's kind of a tough one because the SEC says, well, you don't see projections in IPOs, which is not quite right. I mean, the TXO IPO had a 1-year projection because it's an MLP. The SEC encourages, according to its rules, the use of projections, but they have to have a reasonable basis. So you're starting to see some people start to pitch what they're calling a reasonable basis review, where a third party would basically help the board evaluate projections. That's an interesting tidbit. But it's difficult when you're advising the SPAC because you shouldn't avoid looking at something that might be useful for the board just because you might have to disclose it. So how do you balance, if we asked for this model, I'm going to call it a model. If we asked for the company model and we looked at it and it was sort of plain vanilla and wasn't surprising, it's not material to an investment decision, but to say, I don't want to see it because I might have to disclose it, just seems like the wrong answer too. So it's a tough one.
No, I totally agree. And I think they try to solve an obvious issue, but create other issues in the meantime. And I also always like to point out too that the use of projections is not part of an IPO unless you're a very large, sophisticated institutional investor who basically gets the projections from management via a research analyst. So technically, the investors, the retail community that everyone's trying to protect is the one that's not getting access to the projections, whereas the large institutions are getting them offhand via their relationships with the sell side community on the banks. So just kind of funny because it's just taking away a piece of information that would otherwise not be available to them. John, maybe how have you seen sponsor teams and Ds and Os thinking about their risk and trying to mitigate it?
Yes. So the market responded well. The insurance market responded well to the SEC's proposals because it finally put, if you will, at the simplest, it put guardrails and guide rails into the process, right? So, well-heeled, experienced SPAC operators and franchise SPAC teams were already running good process, but it was something that was kind of, a privileged knowledge, if you will, right? And it wasn't open to the public. And so a large part of the work that I did from 2018 to 2020 was trying to inform the underwriting strategy of the insurers of what are the critical assumptions we can make, or what are the forward-leading indicators that we can identify that they are going to have access to pools of capital to recirculate cash, that they're going to have access to deal flow, that they have these sort of things, and whether you break it down to deep domain expertise or a special situation. So we're looking at those things, and now they finally have guide rails, as I mentioned. So the market responded well. The second part of the question, I think, is, most of those things were already contemplated in insurance, and you had to be very careful about that. You'd get on an underwriting call, call it 2020, and an underwriter would try to sneak in a comment to the team, are you planning on getting a fairness opinion? And you'd have to cut them off as a broker and protect the team and say, listen, we're not going to warrant anything in this application or this call beyond what's contained in our registration statement. So they already had that. They already contemplated related party transactions with exclusions and things. But again, it's opened the appetite and it's made the market softer because now there's some guidance there. As far as the risks contemplated for, they haven't changed. I mean, everything's shifted in the SPAC versus a traditional IPO away from the registration statement to the proxy via the decoupling of the vote and the redemption right. So you still have that profile that's there, that there's very little liability historically associated with dissolution or liquidation versus the combination, right? And then it comes down to how well did you inform the public? You've got those novel challenges where, even no votes, they're challenging how well we were informed for the vote. So dissolution, it's changed a bit, but if that answers it.
Yeah, thank you, John. So maybe turning back to one of the points that Ramey made, statutory underwriter liability, because it's ambiguous right now where those things are going to shake out. You've seen a lot of banks, particularly the largest banks, kind of pull back from the SPAC asset class, and including their existing SPAC sponsor teams that they ultimately brought public. For those of you who don't know, when you raise a SPAC IPO, there's typically two fees that are paid to the underwriter. One up front when the SPAC IPO closes, but normally call it 2/3 of the total underwriting fee is deferred to the back end to when the SPAC closes the business combination, at least in theory, to provide compensation to the bank and motivation for the bank to support the sponsor team that they ultimately brought public, as well as to have some skin in the game alongside the investors. Given the SPAC issuance, there's tens of billions of dollars, I'm sure, in deferred underwriting fees owed to various investment banks. And now they're kind of walking away from supporting their teams in back-end processes. So maybe I'll raise this to anyone here who wants to speak on this subject, but how are banks kind of reacting to the back-end fees they're owed when they're not actually doing anything on the back end? And then kind of on a go-forward basis, how do you think banks are going to look at their fee structures given their, in some cases, unwillingness to support the back-end process?
Sure, I'll try. So a lot of banks where they are not participating in the de-SPAC, because they don't have a contractual right to due diligence, typically how you defend yourself as an underwriter is to establish a due diligence defense. If you don't have a contractual right to do that, many of the banks are just walking away from the fees. They're basically sending a letter saying we waive it, and some of them are also writing letters to the SEC because there's a process where they can send a letter to the SEC that says I'm no longer an underwriter, and so then they don't have liability there either, which is interesting. It's given rise to some interesting back and forth with the SEC. Where the SEC says, tell us why they withdrew. Were there any reasons? Basically seeing if there was any reason for this other than, no, you just dropped this bomb on us that we might be statutory underwriters. Where there are banks involved, they are establishing a due diligence defense. So they're hiring lawyers, they're getting comfort letters, they're getting legal opinions and negative assurance letters. So it's adding a cost to these transactions because instead of having effectively two parties, the SPAC and the target, doing diligence and working on making sure the disclosure is right, now you've added effectively a third set in the banks and their counsel. So that's largely what people are doing. I think, going forward in IPOs, what you'll probably see, and we've seen a couple of these, where there is no back-end fee. There's only the upfront 2%, and then there's usually a contractual right in the underwriting agreement to establish a due diligence defense in connection with the back-end deal, so that basically the banks aren't forced to withdraw.
And when you do go through that process of 10b-5 opinions, comfort letters, and the like, as you think about the overall friction, how much cost and time and complexity would you generally say that adds to a process?
Well, it really shouldn't add time because the underwriter and its the SPAC and its counsel was doing underwriter style due diligence already. In terms of cost, I would think it's probably $500,000 to $1 million. It's what an underwriter counsel would charge for an IPO because you're doing kind of the same deal. Interesting issues we've run into is sometimes the auditors are unwilling to give comfort letters because the FASB has set out sort of in which circumstances underwriters can provide comfort and like an M&A advisor in a SPAC transaction doesn't fit the express guidance of the FASB. So I'd be interested to see if they change that. Otherwise, you're in this weird scenario where you can't get a piece of what is sort of standard due diligence for an underwriter, and so what does that do to the bank?
Thanks for that, Ramey. So I know we're running out of time, so I kind of switched to one really interesting feature that I think we've seen really only very recently, and something that, candidly, I did not expect to see in the SPAC market. So maybe I'll hand it over to Alysa. One thing we've seen, people normally assume when a SPAC completes a business combination, it's going to be effectively the same as an IPO, taking a private company public. After the company's public, it looks, feels, and smells like any other company that's gone public through an IPO. Recently, we've been seeing SPACs actually pursuing public-to-public transactions. Really, I think in two flavors. One would be a New York Stock Exchange or NASDAQ-listed company as a way to recapitalize the target and arbitrage effectively any kind of liquidity risk or solvency risk that may have been baked into the target's share price. Another one is looking at companies that trade on foreign or more tertiary stock exchanges like the Toronto Venture Exchange or the Australian Stock Exchange, or I think I saw one from a Swedish exchange, where they're looking at, which are typically very thinly traded stocks, where they're looking to relist those stocks to the US, which supports typically a stronger growth multiple, put more eyeballs on it, and kind of use that as a revaluation or a recapitalization of the target. So curious your views, Alysa, on these kind of unique public-to-public SPAC transactions and how you think that will evolve over time.
Yeah, so this is definitely a relatively, this has happened before, so it's not a completely new phenomenon. It's just these transactions were very rare because, as Nick pointed out, the primary purpose is really, it's an alternative way to go public. Foreign issuers, companies that trade on foreign exchanges, often view merger with a SPAC as a way to move the listing to another exchange. And what I think is the major challenge from firsthand experience working on some of these public-to-public deals is there has to be a catalyst. There has to be a rationale of why, if you're already a public company on any exchange, the main benefit of merging with a SPAC is not there because you're already public. You already tap public markets in some shape or form. So why would you do a deal? So uplisting is from the OTC listed company is one alternative, is where it's a company that could be post-restructuring situation with a natural shareholder base, highly concentrated shareholder base that makes sort of can make the decisions. In this case, you basically are providing uplisting. You bring liquidity into the stock. You have to make sure that you ultimately preserve the requisite number of registered shares, so i.e. redemptions have to be under control in order to justify for that, because otherwise you will basically just undertaking more dilution and you're not solving your objective. With foreign issuers, there is not necessarily a very easy, what's driving them in a lot of cases is, let's say, there's a multiple arbitrage. I'm trading in Europe on the illiquid exchange, not enough liquidity, I'm trading at 5 times, the US comps are trading at 12 times. Not that fast, because you actually have to understand, first of all, will the US investors appreciate the company and its story? If it's a local, sort of, let's say, local European market-centric story, it may not necessarily resonate with US investors. It may not be valued at the same multiples that you believe. You cannot, and even if that type of arbitrage is achievable, it may not happen on day one. So you have to be careful about it. Things that do work in this context are things where there is a catalyst. It could be, for example, ODC listings or uplisting situation, or with the infusion of the capital where there is guaranteed capital coming in through a pipe to reduce leverage, for example. Two companies merging together, and SPAC is acting as a vehicle, as they probably some of the past examples. DraftKings deal was an example of two companies coming together where SPAC was used as a vehicle to raise capital to affect that business combination. Those kind of situations do work, but generally these deals are fraught with a lot of risk. They are not; they're extremely rare and not easy to execute. So we had really case-by-case basis.
Great. Thank you, Alysa, and thank you, Ramey and John. Really appreciate it today.
Thanks a lot.
Thank you.